Okay, Chapter 11 covers the topic of getting rid of assets, how you take those off the books. Um, it also covers natural resources. Hold on, I'll get to the right spot in just a minute. Let me see, I've got another one here. Okay, natural resources and intangible assets. Plant assets, first of all, let me explain. Plant assets, again, land, building, equipment, that sort of thing, get depreciated. Natural resources, which are things that again come off the earth or from the earth, something like that, get depleted. Because think about it, if you take the oil out of the ground, you have depleted that oil supply. So they get depletion, accumulated depletion. Intangible assets are amortized. So you've got some new terminology here. Remember, you've got depreciation or depletion. It's very logical. Natural resources get depleted and intangibles get amortized, which is kind of a new term for you. Okay, we start with the disposal of a plant asset. Whenever you actually get rid of an asset, you have to take the original account where you put let's say it's a building. You have to take the building account off the books by making it a zero. So if you put it on the books at $30,000, you'll have to credit that building for $30,000 to take it to zero. If it had accumulated depreciation of $20,000, which is a credit, you have to debit accumulated depreciation for $20,000 to make that zero. The third piece of information will be given to you, and that is how much money did you get for the asset. May have been none, but if you got some, you put that in the equation. Then you figure out the number that you have to balance the entry. If it's a debit, you have a loss on the sale of the equipment or disposal of the equipment. If it's a credit, you have a gain. So don't get too hung up on trying to figure out this gain on disposal of assets. Put in the cash that you're given, take the equipment off the books, take the depreciation off the books, and then what you had to have to balance this entry was $4,000. It's a credit, so it's a gain. Remember, revenue is a credit, so that's a gain. Same example down here, but you only get cash of $28,000. Put in your cash, take out the building, take out the accumulated depreciation. You need $3,000 to balance that entry, and that is loss on disposal. It's a debit, so it's more like an expense. So it's a debit on loss of disposal of assets. Trying to figure out this gain on disposal is just don't even think about that. That's always going to be your balancing figure. Now, if you get rid of a plant asset in a period where you were not doing financial statements, the first thing you have to do is bring your depreciation expense up to the date of sale. Say you hadn't taken depreciation since last December. You sell the equipment on July 1. You have got to make sure you have on the books 6 months worth of depreciation expense and accumulated depreciation. You have to bring those totally up to date before you take the asset and the depreciation off the books. So just remember that. You always have to account for it up to the date of sale. If you just retire some assets, they have no value left, you can't sell them, you just simply take them off the books, and the machinery and the accumulated depreciation would be the same. No book value left at all, no cash involved, just take the two accounts off the books. Destruction of plant assets, again, you would take the building off the books, take the accumulated depreciation off. You're not getting cash, and this time you have an expense. You have a loss due to the fire. So whatever you had in book value, which was $28,000, you lost that much on the books. So you just debit fire loss in that case. We're not going to cover exchanges of non-monetary assets. I realize I put a problem in for you that had some of that in there, but I'm not going to grade those last few questions or lettered items in that problem on exchange of non-monetary assets. What I will do, maybe if you did it and got it right without any help from me, I might give you some extra points. I think that would be a good way to handle that. Again, the things that I'm not covering are not because they're not important things in general. I'm not covering them because as business admin majors, they're things that you would never have to do. If you're going to go on in accounting, as I said, then we'll get to that in intermediate in a lot more depth. Because we have so many chapters to cover in such a short period of time, we have to really just kind of skim some of these chapters. So don't feel like you're being left out of too much. Again, if you don't go into accounting, if you've heard the terms, that's about enough. So, okay, natural resources. Again, those are things that you take out of the ground, off the ground: timber, oil, mineral deposits, gas, any of that sort of thing. And those you are always, it's called depletion, and you're always going to use units of production. So what you do to calculate that is you figure out, let's see, let me start at the bottom. To compute depletion charges, companies use the unit of production. You divide total cost by the estimated number of units, tons, barrels, or board feet. This calculation provides a per unit depletion cost. So the example is the company paid $650 for a tract of land containing ore deposits. The company spent $100,000 in exploration costs. The results indicated that approximately 900,000 tons of oil can be removed economically from the land, after which the land will be worth $50,000. Okay, so what they have done is the formula we'll look at first. Cost of the site minus its residual value plus the cost to develop. Divide by the number of units that can be economically extracted. That gives you depletion per unit. And now it says the company incurred $200,000 to develop this site, including the cost of running power. So when the property is purchased, the journal entry was made. The land was $50,000. The ore deposits for a total of $600,000. Cash $650,000. Then after that, they recorded the cost of exploration and development. They did in two different entries. Now, when you get over here in the example, 100,000 tons are mined. This entry records depletion of $100,000 because they came up with $1 per ton, and accumulated depletion on ore deposits, 100,000. Okay, not too hard. We're not going to look at extractive industry or extractive industry. We're not going to look at that. Let's go to intangibles. Unlike plant assets, intangibles have no physical substance. You can't touch them, you can't see them. It's copyrights for music or books. It's a trademark. You might have heard of, I guess it was Verizon who sued Samsung for copying their phone. It looked too, or was it Apple? Maybe it was, I can't remember. But it looked too much like the other company's phone, so Samsung had to pay millions and millions and millions for trademark infringements. But intangibles, they're exclusive privileges granted by the government or authority or by legal contracts such as patents, copyright, franchises, trademark, trade names, and leases, and superior entrepreneurial capacity or management know-how and customer loyalty, which is called goodwill. Okay. Companies can buy intangible assets. If a company is planning to develop a new product, all of the expenses incurred in developing that product must be expensed. They cannot be capitalized and depreciated or amortized in this case. That's why when pharmaceuticals are developing a new drug, all of those expenses that go into trying to find the drug, to get it through the clinical trials, get it approved, all of that gets expensed right then and there. So then when the drug actually comes to market, it's outrageously expensive because the drug company is trying to make up all those expenses they incurred in bringing that drug to market. So amortization of intangible assets, it's different for a lot of the different forms. You can't amortize something with an infinite life. If it goes into perpetuity, you can't amortize that. If it has a finite life, you can amortize it. Let's see. I want to see if I can just find a quick anything that you can't read through yourself. All right, let's talk about a patent. A patent has 20 years. Protection for a patent owner begins at the time of the patent application and lasts for 20 years from the date the patent was granted. Patents are handled a little bit differently. First of all, if the company doesn't think the patent will benefit them for 20 years, they'll use whatever number they think is proper. If they think the patent's only going to help them for 10 years, they'll amortize it over 10 years. Patents, for the most part, do not use an accumulation account. I don't think most intangibles do. It's not like when you're talking about a building, the accumulated depreciation cost gives you some idea how much life is left in the building. Same way with oil deposits. If you can see how much has been taken out, you know how much is left in the ground. You've got some idea of the value. Patents aren't like that. It's not like you can see something about them by using an accumulated account. So they just amortize the patent by crediting the patent account. Patent amortization expense and credit patents. Copyrights, of course, and they go for the life of the creator plus 70 years. Franchise, of course, everybody can think of McDonald's. Let's see. Let me see what they say about the time factor here. The legal life of a franchise may be limited by contract. Let's see. That's about all that you need to know about that. Trademark, again, that's a symbol of design. It's not something concrete, but if you see, what was it, these pillow pet toys, my grandsons loved those when they were little, and somebody came out and developed some that looked pretty much just like them, but they had to have some difference or they would get sued for copying the original pillow pet. I'm going to skip leases. It's a whole chapter in and of itself. I will say that if you buy something and you lease it for 4 years and at the end of the 4 years it's yours, that's not really an expense. That really has to be set up as equipment. If you're renting a car to drive to the airport and back, that's an expense. That's not a capitalized lease. Leasehold improvements are not going to cover. Goodwill is a subject you will hear, so we're going to talk about it just a little bit. If one company buys another company, Company A buys Company B. Company A pays $300,000 for Company B. If Company A's assets less their liabilities is only $250,000, take their assets, subtract out what they owe. They have $250,000 in net assets. If we pay $300,000, we have paid $50,000 more than we're actually getting on the books, and that's called goodwill. Why would you do that? Maybe Company B has a customer list that is perfect for a new product you're developing, or you just want their customer list, period. There are all kinds of different, maybe they have a patent that you can't get unless you buy the company, and that patent might be worth $50,000 to you. So that is called goodwill. It is not amortized, but every year companies have to analyze that account and see if it is still worth that additional money that you paid. And if it's not, then it's called impaired, and you have to make an entry to take the value of that goodwill down. This is a subject beyond Principles 1 for the most part. Just want you to know what goodwill means. It just means that a company pays more for another company than the assets less the liabilities. All right, let me go back here. Here now is what we've got going on with the balance sheet. We have property, plant, and equipment. We did those in the last chapter. Under natural resources, you have mineral deposits less accumulated depreciation. Intangibles, you have patents and goodwill. You don't have any accumulation accounts going on in the balance sheet. All right. And that is that for that chapter. And I will redo chapter 12 after this, and hope that it will be a